The best way to handle long-term care expenses. In this episode, I'm going to address a current question. Why is Washington state mandating that employees at any employer have long-term care insurance? I'm going to share with you why they're doing that and what you can do that's probably going to be better. So, my name's Doug Andrew. I've been a financial strategist and actually helping people prepare for a comfortable retirement for more than 48 years. And I've noticed that a lot of people try to accumulate a nest egg that will hopefully allow them to enjoy retirement at the same standard of living or better than they had during their earning years. Sadly, a lot of people outlive their money due to the negative impact of taxes, inflation, and market volatility. But there's another expense that sometimes takes a toll on people to the tune of hundreds of thousands of dollars. And that's if they end up needing long-term care. They have to go to a nursing home or what have you. And so I'm going to share in this episode 3 different alternatives that you may have, but the state of Washington is so concerned about this that they're mandating that employers check to make sure their employees have that. Otherwise, the government is going to do it for them. And whenever government decides to do something for you, I always go, they're not very good at this. They haven't been very good at Social Security, have they? So I'll share with you the bulletin from Washington State, because as of the recording of this episode, it just is going into effect. And then I'm going to share with you what you can do that is probably going to be better. So I'm going to read directly from this bulletin, and this came out of Seattle. Starting October 1st. Now, that's October 1st of the year 2021 when I'm recording this. It's in the month of October. Residents of Washington can apply to opt out of the WA CARES Fund, a new long-term care insurance benefit for workers in Washington state. The program, which will be funded by a mandatory payroll tax, will help pay for eligible long-term care-related expenses. Beginning January 1st, this would be the year 2022, every employee will pay 58 cents for every $100 they earn. Now, I know people go, well, that's not very much. Well, if you make $75,000 a year, you'll pay $435 a year for this. And Washington is going to make you do this unless you opt out. The program will initially pay out $36,500 in long-term care benefits starting in the year 2025. The rest of this bulletin talks about how you can opt out of this. You have to prove that you have done something different or that you're going to be responsible for those long-term care expenses. Otherwise, they're going to make you pay for it or be insured through their system. Okay, I've had a lot of people ask, golly, Doug, what's your take on that? Well, first of all, yes, there's a lot of people in retirement that end up in a long-term care facility. Now, the truth is, many of them don't spend a long time there, but, they quote statistics that there's a lot of retirees that will end up having to go to a facility. But if you stay there a long time, it can get expensive and it can wipe out your financial resources. So let's go through the 3 different ways that most people try to cover long-term care expenses. Here we go. On the screen here, I have the 3 different options based upon a spectrum, okay? Now, the number 1 option that has been available for the last few decades is traditional long-term care insurance. In a nutshell, what you're doing is you're buying a long-term care insurance policy and you're paying premiums several $100s a month. If you're older, maybe several $1,000s, depending upon the benefit. And it is probably the most expensive way to go because you're paying a premium. that is pretty hefty for as long as you want that coverage. And, you know, if you don't ever need long-term care, it's sort of money down the drain, just like insurance, health insurance, and you never were unhealthy or needed it. It's just a premium you pay for the risk that you may need that. So long-term care insurance, you only really get something back if you end up in a facility. Nobody wants to do that really on purpose. And so this gives you the greatest benefit for the dollar if you need it. But it's pretty expensive, and a lot of times people, you know, they think, golly, that's pretty hefty. I'm having to give up a lot of my retirement income or resources to be able to afford that. Now, over on the other end of the spectrum, let's go to this one, number 3. This is where many times people use other resources, and the most common would be life insurance. Now, I've helped people for the last 48 years to be able to insure themselves with life insurance, and the way I do it is I want Uncle Sam to indirectly cover their life insurance costs by redirecting otherwise payable income tax. That's a topic of many videos on this YouTube channel, 3-Dimensional Wealth. But what happens with life insurance is if you end up having $500,000 or $1 million or $2 million or $5 million in death benefit, many people that come to me, they have a load of money or cash value in their insurance policy because they're using it for living benefits. So they're actually accumulating their money tax-free inside the insurance policy. And if you have $1 million or $2 or $3 million in there, I'm saying, golly, you could just dip into that and use that for long-term care. And so many clients have done that. There are some insurance companies that if you have a $1 million death benefit and you have long-term care needs, they will actually give you what is called an accelerated death benefit. It's usually a rider. And that's where you go, you know what? I just want to access some of my death benefit without having to die to get it. So you give up getting some of the death benefit to be able to go to your beneficiaries, and the insurance company gives you long-term care or some money for long-term care expenses out of the death benefit, and so your death benefit is going to be reduced. Okay? That can work also. So that is the other end of the spectrum where people actually have life insurance that they can dip into with cash value or even the death benefit if need be. In the middle is what is called an asset-based life insurance, okay? And this is probably one that I would recommend for many, many people. This is where people just want to flat out self-insure. Now, before I explain that, I want to share with you why you should subscribe to this channel. If this is resonating with you and you want to learn more, I'm very passionate about educating people like you with opportunities that maybe you didn't know existed. That's the purpose of 3-Dimensional Wealth on this YouTube channel. Now, it's free when you subscribe, so click subscribe and also click that little notification bell so that you'll be notified every time I post a new educational video, which I do almost on a daily basis. And as I'm sharing with you these concepts, post a comment, okay? Share with somebody who you know ought to hear this information, especially this particular episode. And when you do, I'm going to share with you at the end how you can claim your free copy of one of my books to help you learn more about all kinds of options you have if you're already intrigued from what I've said thus far. But get ready, I'm not done. Here we go. So let's go back to this asset-based concept. I've found that a lot of successful people, they self-insure. They have like a rainy day fund. And so if you have a rainy day fund, you're self-insuring. Many people say, you know what? I don't want to sit there and pay $1,000 a month into a long-term care policy. I would just like to earmark $50,000, $100,000, $200,000 in our bank or credit union. And so they choose to do that. Now, I look at it and I go, the bank or credit union is only crediting you a measly 1% or less. That's pretty pathetic. But it's amazing how many people have a rainy day fund of $100,000, $200,000, and they say, well, just in case we need it for long-term care expenses. I go, okay. And so they do that, and let me just show you 3 different scenarios, okay? If they live and they need to dip into, let's say, $100,000 rainy day fund at the bank or credit union. Basically, it's there and it's not even keeping up with inflation. So we're just going to say the purchasing power is going to be 100,000 or maybe less in the future. Because if you're rowing upstream at the rate of 1% interest, 1 mile an hour, and the current of inflation is coming down at 3 or 4, you're actually losing, right? But you have it there while you're living. If you quit, you can go just withdraw the 100,000. You say, you know what? I'm just going to use the money for something else. I'm not going to worry about it. If you die and you have that 100,000 in a bank or credit union, you leave behind the 100,000. Okay? It's 100, 100, 100. Live, quit, die. Let's look at a different way to approach this. Many times when I come across these people, I'm saying, well, if it's just going to sit there in a bank or credit union earning a pathetic interest rate, why don't you do an asset transfer? Now, that means you're taking that 100,000 in this example, that rainy day fund, and you're moving it from this pocket in the bank or the credit union account over to this pocket into an insurance company. And generally, insurance companies, the one that I'm talking about is called Pacific Life. It's rated AAA. Many banks are only rated BBB. So this is like 6 notches higher in safety than most banks and credit unions. And so you're simply moving the 100,000 over to the insurance company. Now, they will hold that 100,000. They're going to use that money, of course, but here's the difference. If you put the 100,000 into the insurance company with this, what is called Premier Care Choice is what they call theirs, and you all of a sudden had to go have long-term care really soon, you would qualify for $346,600 of long-term care benefits on day one. At age 80, if you did this when you started at I think age 65, it would end up paying out $647,992, okay? The point is this: if you need long-term care, the insurance company is on the hook to pay it out. Whereas if this was still sitting in the bank, it would be gone once you used up 100,000. Now, anytime you quit with this one, you say, no, I just want my money. The insurance company will give you your 100,000. You get your 100,000. You can take it out anytime you want. You're no longer going to have this benefit if you need long-term care, but you can go grab your 100,000 out just like a bank or credit union. And if you happen to die, they will pay out $100,000 to your beneficiaries if you didn't use it. The difference is, if you leave it in a bank or credit union, it's only $100,000 whether you live, quit, or die. If you put it here, you're transferring it from this pocket to this pocket, increasing the safety. And if you need it, it's incredibly better. But if you decide to quit, you just take out your 100,000, or if you die, you leave behind the 100,000 if you didn't need it. To me, this seems like an absolute no-brainer. And so there's a lot of options, and if you chose something like this would be far better than giving up a bunch of your paycheck in a state like Washington, because I can assure you other states are watching what's happening in Washington, and they're going to probably start doing this and requiring it in those states. And in Washington, you only had like a window of time to opt out. I would recommend you opt into something like this before your state may implement it, so that you're already covered and you can opt out within the time frame and say, nope, I have taken care of my long-term care expenses if they happen. So if this is intriguing you, I would recommend that you learn more. Now, many people, they simply maximum fund their insurance contract, and that suffices because they can access money tax-free if they need it. You may even want a combination of these two strategies, the second and third that I had on the screen. So if you want to learn more, go to laserfund.com, L-A-S-E-R fund.com, and you can click on the link below to do this. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost. I'll pay for the book. It's 300 pages. And this will teach you how to diversify and create the foundation for a tax-free retirement. This white covered side is 200 pages, 14 chapters with all kinds of charts and graphs and explanations for the left brain learner. If you're a right brain learner, you learn more by stories and examples. You flip it over, and this has 12 chapters with 62 actual client stories. and you'll be able to understand how you can diversify and create the foundation for a tax-free retirement. When you do subscribe, then you'll be on the notification list that when we teach educational sessions and webinars on this, you'll be able to attend to learn more about strategies like this so that you'll be prepared and not be taken off guard if your state adopts the same laws that Washington just put into effect.